GST cuts are in the form of a fiscal stimulus, wherein the government is saying that we are ready to forego some revenue and we want the disposable income of the end consumer to go up, because of which they will see they are expected to participate in consumption. They would see a feel good effect, and all of this starts to lead into once again a reversal of the slowdown which we have started to see. This was a tiny company which was growing at 40-50%. It did returns on equity in excess of 30% at that point of time, and it was expanding its entire branch network at a scorching pace. This is the first stock where everything panned out exactly picture perfect in the way it was expected. But at the same point of time, I also invested in another stock, which was a retail company, and everything which could have gone wrong went wrong. What I have experienced in my few decades of experience, companies which are facing disruption are the most difficult investments. They are value traps, and hence I think making a case for investing in an IT company just because the P multiple appears low would be a value trap. Clearly, the automobile sector and this followed by the consumer durable sector is one of the biggest beneficiaries of the GST cuts which have been announced by the government. From this perspective, there is one particular entrepreneur which has caught our eye is
Hi Vinay, thank you so much for coming on. Welcome to the Krish Kothari Show.
Hi, Krish.
Major talking point at the moment is tariffs plus these, cuts that the government has made to taxes and how that affects the economy, consumption. What is your overarching view on these cuts, and do you think they'll have the desired effect?
Krish, the cuts which the government has taken, these are part of a series of sort of stimuluses which the government is giving to our economy, because the economy has started to see some sort of weakness starting the just about a year back. So from second quarter of previous year, we started seeing weakness in consumption, and that continued to accelerate in terms of deceleration over the last one year's time frame. Of course, the government is privy to all of this data and understands that. So the first stimulus came in the form of a very loose monetary policy. The monetary policy which we saw was like a 50 bips rate cut, and it also saw a significantly large CRR cut completely out of the blue. We never expected that. And that clearly told us that the intent of the policymakers is to clearly see some bit of improvement in the economic environment. And that was the first stimulus which we saw about maybe 6 months back. And after that, even after that monetary stimulus, we have continued to see some bit of economic slowdown. There was some expectations of some improvement 3 to 6 months from that point of time, because of course monetary policy takes time to take effect. Suddenly we saw this huge tariff challenge which was imposed by the United States on many countries, and of course India was one of them. And India also had to bear a brunt of an additional tariff. So almost a 50% tariff is like not going in for any trade, and it's like just stopping the entire trade with a particular country. And because of that, there is likely to be a material negative impact on the economy, and which of course the government also was envisaging. So I think more or less these GST cuts are in the form of a fiscal stimulus, wherein the government is saying that we are ready to forego some revenue and we want the disposable income of the end consumer to go up, because of which they will see they are expected to participate in consumption. They would see a feel good effect, and all of this starts to lead into once again a reversal of the slowdown which we have started to see. So I think more or less, and of course, one of the other things which we saw is the income tax reduction in the budget. So I think all of these are a series of measures which the government is trying to take, the monetary authorities are trying to take to contain this slowdown which we are seeing. Not a big slowdown, but at least the signs of slowdown, which of course, if you correct them in the initial phase, we do not see a material slowdown and don't see a depression, and hence the economic growth can be revived. So I think that's what is being the intent. Clearly, this is likely to be material in terms of its impact on consumption, and there is an expectation that there will be a material rebound in consumption from the festive season itself this year. And of course, it should also result in some improvement in the economic growth environment going forward. So it's not just 1 year or 6 months, but it should kickstart the economic growth activity again.
Let's talk about different sectors that presumably will be beneficiaries of these cuts. I want to start with the auto sector. If you look at the OEMs, and a lot of them have already started announcing that they're gonna, there's gonna be a pass-through of the tax cuts. How do you see demand playing out for them over the next 18 to 24 months? And how do you look at those businesses over that time frame?
Clearly, the automobile sector and this followed by the consumer durable sector is one of the biggest beneficiaries of the GST cuts which have been announced by the government. And one of the big reasons is that the demand is much more elastic in these categories. So for example, if the demand for toothpaste is, if the price of a toothpaste is cut by 10%, tomorrow you don't go out and brush 10% more, right? But if the price of a car is cut by 10%, there are a lot of people on the margin who aspire to own a car, and for them, a 10% reduction is a materially large reduction to bring a lot of people who are fence sitters into the demand curve. So the elasticity of demand is significantly higher in these high ticket price consumer products, and automobile is at the top of that. And hence, there is an expectation that automobiles would do good. And remember one more important aspect. We just don't want to look at sales growth. As investors, we always get interested in profit growth and sustainability of that profit growth. When you look at the automobile sector, these are companies which have got reasonably low contribution margins and significantly high operating leverage. For any percentage change in revenues, the percentage change in profits and EBITDA is much, much higher. So there you see the leverage. Small changes in prices makes consumer buy more, so volume growth goes up. Because of this, revenues go up, and the ultimate impact on profitability is much higher. And hence, the delta to profits for this sector is likely to be the best. And of course, these reductions are not one time. They are permanent, right? Because GST has been reduced. And hence, since this is more permanent in nature, we expect the structural curve for demand to move up for most of the automobile, starting with two-wheelers and then affordable four-wheelers and so on and so forth.
Can you just double click on this idea that effectively the tax cut is a start of a structural change where broad-based demand increases? Presumably that works out over a long period of time. But if you think of the more near term, is it that more people are going to buy a car because of this? Or is it that everyone who is anyway going to buy a car is just going to pay a little less for it now, and therefore, they save a little more money, but that additional money saving, it may be spent in the economy, but it's not the autos that are the beneficiaries of it?
I would just not say that, it's just additional savings for people who are anyways going to buy a car or a two-wheeler. it is conversion of a lot of fence sitters into the ecosystem of owning a car or owning a bike. And secondly, people who are already planning to buy a car, it's like buying a real estate, right? That you wanted to buy a real estate. If the prices go down, instead of buying a one-room property, you buy a two-room property. So instead of buying, let's say, a small car, a consumer may upgrade to a bigger car and so on and so forth. So I think that all plays to this on the psyche of consumers. Historically, we have seen that, as I said, the elasticity of demand is much higher in this category, which means for every 1% change in or reduction in price, the increase in demand is not just 1%, it is much higher than 1%. So I think that is why the benefit of reduction in prices will be material in this sector, particularly the OEMs. And as a natural corollary, if the OEMs see volume growth, it gets trickled down into the entire ecosystem of the auto ancillaries. So of course, the auto ancillaries also experience volume growth, and they also witness something which is called as the an equivalent of happiness sharing. So when we have heard of pain sharing, right? But when the OEMs are experiencing good times, there is also something which we can think of as happiness sharing. So the margins will get to some extent passed on to the entire ecosystem.
There's this theory that the Chinese auto sector poses to some degree an existential threat to other auto companies all over the world. It's nothing specific to India. And you could argue that India may be a little more sort of protected from it than, say, some European countries or so on. What is your view on this theory that the sort of lower end of the EV auto sector is going to get flooded by Chinese vehicles all over the world? And I'm, of course, asking more in the context of India. And do you think, A, that is possible in India? And B, let's assume that that is possible to at least some extent. How does that affect the economics for the Indian players, particularly at the relatively lower end of the spectrum?
Krish, it is plain vanilla economics that if consumers are offered better products, more durable products at affordable prices, people will want to buy them. And I think it's plain vanilla theory of choice. So if Chinese are offering you better products with better technology at a lower price, I'm sure people will want to buy it. And hence it is up to the Indian ecosystem to gear up to take this challenge and be able to offer a good quality product, a good technology at an affordable price. And I'm sure people always prefer Indian brands to Chinese brands. There is a clear sort of a negative aura about durability around many of the Chinese brands, and that's clearly going to rub off on Indian brands, which means Indian brands are expected to be more durable, more a little bit more quality conscious, and of course they have a very good sales and service network. So there are moats around a lot of these Indian brands which are difficult to penetrate by a new foreign brand overnight. It will take some time. And similarly, Indian brands need to innovate, offer better products at affordable prices. And I'm sure if that happens, it will be very difficult to compete against the Indian players. So I think that's how we look at not just in EVs, but in any other type of product or service. And hence, I think it's important for Indian brands to offer good quality products at reasonable prices with good technology.
Completely unrelated question. Do you remember the first ever stock you bought?
Was a gold finance company. Pretty small at that point of time, not much was known about this sector. And this was a tiny company which was growing at 40-50%. It did returns on equity in excess of 30% at that point of time. and it was expanding its entire branch network at a scorching pace, because if you have this kind of business economics, uh, growth is not very costly. So it did not dilute much, was growing at the scorching pace because it was all supported by ROE. So it was a dream for any investor. The only challenge was it was small and it took a lot of time to accumulate.
When you look at the stock today, did things broadly pan out as you imagined they would?
I think this is the first stock where everything panned out exactly picture perfect in the way it was expected. But at the same point of time, I also invested in another stock, which was a retail company, and there everything which could have gone wrong went wrong. So while this gold financier kept on growing without material leverage, steady returns on equity, the other retail company which I invested in, this company uh, also went on a extremely fast growth spree, but it was having a much lower return on equity, which meant that it had to take on much more level of debt. So the leverage kept on increasing, and there it was in 2008 or 9, GFC struck. Most of the consumers pulled back their purses, and it was stuck with a huge level of inventory, which was slow moving, and they had to take a massive write off. It almost went bankrupt, and we lost almost 75%. So this is a company where we lost 75%. The other company we made 16x. So these kind of things happen. In hindsight, is very clear. Everything is it's crystal clear. We all know everything. But at that point of time, both these companies appeared very promising. So it's not that you should have avoided one and invested in it. So yeah, that's my memory.
I guess, especially if you're investing for the long term, you have to accept that no matter how much homework you do, sometimes things just aren't going to go your way. I think that's just the reality of life as an investor. Vinay, I want to now talk about another sector that appears to be at the other end of the spectrum in terms of, if the auto sector is a beneficiary today, this seems to be, nothing seems to be going right for this sector, which is the IT sector. There's two prongs on which that sector appears to be being attacked today. One is AI, and one is what technically doesn't exist as yet, but people see as a very real threat, which is this idea that regulation will come out in the US that essentially negates any cost arbitrage that exists today. Assuming that that does play out and these two issues remain, how do you view that sector in light of that reality or potential reality? And if you had to make the bull case for IT today, what would you say is the bull case for that sector?
So I think you talked about the right pain points for IT today. Um, I think this sector has lost a great opportunity which it was offered over the last many years. And this opportunity was to innovate, to be at the cutting edge of technology, and to productize itself, to offer consumer or enterprise products, services which are differentiated. So when you talk about Indian IT, all of the IT companies, in fact, the major ones, are ones which offer IT services. In simple words, they are offering you outsourcing. Uh, in in the year 1999, 2000, we used to loosely call it body shopping. And now it might be a little sophisticated in the way we call it, but all of that is very similar even today in terms of business model, which is that I offer you a resource for 1 hour. What will you pay me for that 1 hour? And I pay the employee or that person 40% of what I get or 30% of what I get, and retain rest for sales and marketing and growth. So I think much of the IT services which you see in India today is all of this very homogeneous and very much dependent on outsourcing. So when we look at the ladder of value, we are at a very low end of value. We are dependent on clients for reducing their cost. We have not entered the revenue line. So I think the IT services, many of them have sort of lost that opportunity. And why do I say that? Because they have been making very good profits. They had a very good run in terms of generating cash flows for the last 15, 20 years. Some of these cash flows could have been invested into development of cutting edge products or services, or going in the front end rather than being at the back end. So I think now that all of this has been lost, we are now seeing an environment where clients have started to take advantage of tools like artificial intelligence, which render most of this work redundant, which means you don't need an expert human coder to code for you. You can go to a vibe coding platform and it just does everything for you in a matter of it's in a matter of few minutes. You don't need to learn a lot of new languages. Everything is built into artificial intelligence. So I think a lot of this work is likely to become redundant. Some of the companies are trying to utilize artificial intelligence, and I'm talking about the IT services companies in India. They are trying to utilize AI to do some of the low end code and trying to do some high end coding work or some other such high end work, which at this point of time is not the capability of AI. But at the speed with which we are seeing the development of artificial intelligence networks, I think it is only a matter of time that a lot of this work gets redundant. So, what I have experienced in my few decades of experience, companies which are facing disruption are the most difficult investments. They are value traps. And hence, I think making a case for investing in an IT company just because the P multiple appears low could be a value trap, because we have very clearly defined what is value investing and what is a value trap. Value traps are companies where the intrinsic value in future keeps on falling, or there is a reduction in fair values over a period of time. Whereas companies which experience some growth in intrinsic value and you are able to acquire them at a lower than intrinsic value price today, there could be an example of value investing. So I won't even say that many of these ID companies are cheap and hence should be attractive, and hence I can't make a bull case based on value. Uh, the only bull case which I can make is that there could be some companies which are working on innovation, which are utilizing this opportunity, which they still have, of doing some of this high-end work for their clients today, to develop some innovative products, services, which can help them sustain their business in future. But make no mistake, there will be a material change in the nature of work, which many of these companies will be undertaking in the future. So yeah, this is one of the sectors which is prone to material disruption.
Do you ever fear that AI will take your job one day?
So if I don't change myself, if I don't adapt, if I don't utilize AI to the extent to which it should, it will take away my job. And if I, in fact, it will be taking away lots of jobs. So make no mistake, uh, whoever does not adapt, learn, and offer better value to their to the ecosystem of their stakeholders, he is likely to be disrupted. So I think clearly there is a lot of sectors, including financial services, portfolio management, customer services, uh, information technology. We can talk about sectors and companies and types of work which are all getting disrupted, but there is clearly many of them which are going to be disrupted. It's only a matter of time. So there are some activities which are going to, which are like low hanging fruits. They will be disrupted first, but as time progresses, as AI becomes more and more efficient, complex, sophisticated, A lot of the other so-called sophisticated work, including maybe portfolio management in future, might be taken away. So as we have all talked about stock investing as a blend of art and science, I'm sure the science aspect will be completely be taken away by computers.
I was going through all the different funds that you're involved with, and in many of them, you have a lot of exposure to companies related to the telecom space. And of course, there's multiple listed entities, but in some sense, there's two that everyone really cares about. And so you could argue there's maybe 2.5 players, or however you want to look at it. What is your view on ARPUs going ahead? Are you in the camp that there is going to be an inevitable rise in ARPUs? And to what extent can they rise without changing the competitive dynamics in the industry? And what I mean by that is, how high can they get so that the existing players can maximize profit without them becoming so high that it allows another entrant to come in?
I think it's a very easy answer. There are some sectors which are difficult sectors by the nature of industry structure. And conversely, there are some sectors which are fantastic sectors by the reason of their industry structure. So while you talked about telecom, you can also look at aviation as another example. When there are sectors which have consolidated, even if these sectors are perfectly competitive sector, as we would have learned in our grade 1 microeconomics, even if they are perfectly competitive by the virtue of capital requirement and by the virtue of industry structure, there are large moats around these sectors for new competitors to enter. When you look at telecom, it's a very interesting sector, especially in India. There are just two players which are relevant players. We can talk about three, four, whatever, but we all understand that in terms of revenue market share, it's a duopoly. In terms of uh, the mental model with which we look at this sector, it is a duopoly which has pipes running to almost 140 crore Indians or 120 crore Indians who have a mobile phone. And these two companies control 120 the pipes to these 120 crore Indians. And no matter what happens to the pricing, unless and until you take it to a level where the affordability completely goes out of hand, and I'm sure they will be smart enough not to do that. But you keep taking away the consumer surplus at all points of time. Remember, while it's slightly technical, in microeconomics, we talked about demand curve being downward sloping, right? So there are people who can pay a much higher price and will still continue with your products, and but yet they are paying a lower price. So anyone who is above the pricing line is enjoying a huge consumer surplus. When you raise prices, some of that consumer surplus is taken away. This is a sector which can take some of that consumer surplus. And even if you take away some of that consumer surplus, they are left with a huge level of returns on equity. That is first level of ROE increase. But when you look at it over a longer period of time, in the next 5 years, 10 years, this is a sector where you can keep adding more and more services and keep on increasing your overall share of consumer expenditure. So if the consumer wallet is 100 today, your share of the consumer wallet is 1, 2, 3. Let's say you add one more service, this 2, 3 goes up to 4, 5, and so on and so forth. It is a sector which has got pipes, and very difficult to break these pipes. And importantly, whoever enters this sector needs to have deeper pockets than these players. And remember, these are not small companies, right? So even if a new player comes in, he should be ready for bleeding, and the entire sector will bleed once again for a 10-year period, because everyone is aware that this 10-year bleed is equal to your capex, and whatever you recover is after that. So I think this is a sector which is now bearing the fruits of the past bleed, and it is a sector which is opposite of disruption. So it is a beneficiary of whatever new things we are seeing around us. It is a beneficiary of per capita income going up. Straight away, everything comes to this sector first, right? You can so now broadband, Wi-Fi has become the fourth most basic need. So I think people are misreading this sector. A lot of people are talking about valuations and the fact that they've already seen a lot of increase in ARPUs, etc. But when you look at business models, this is one of the sectors and the companies within that, the business models are having a significantly higher and deeper level of moat than most other sectors which we are seeing. And hence, we think the runway to generating significantly stronger free cash flows, even from this level, is the best for this sector. And remember, it is a consumer sector. So we are very positive on this sector for this reason.
What you explained right now is, in some sense, the prevailing opinion that everyone, or well, not everyone, but a lot of people think that it's very difficult to compete with the two primary players in the telecom space in India now. But do you think that if there is any threat, it is companies like Starlink, where the form factor is such that they don't need to make the kind of capital investments that, say, the existing players have had to make historically?
Or may not happen once again, Krish, because uh, the kind of pipes which need to be laid for reaching the nook and corner at an affordable rate is difficult, right? The technology needs to be far more mature for you to take advantage of reaching directly to consumers. So it's just like saying we had cable networks some years back. They had their pipes all across to various consumers, and then you had the DTH companies. They came over the top, right? So at that point of time, clearly most of these cable companies got disrupted. But right now, when we are looking at most of these telecom companies, at least based on what we are seeing in terms of current level of technology evolution, you need a mesh of towers spread all across the country for you to be able to offer a reasonably good experience of both data and voice. While some consumers will be able to afford the option of uh, Starlink or some of such services, but these services going out mainstream will be far more difficult for purely for technological reasons. And tomorrow, if there would be a need, I'm sure the domestic operators, the primary operators, would should be also be able to offer this, and their reach with their consumers at this point of time is far superior. So I think, and this goes with any sort of industry and sector. If a player does not cope up and upgrade himself with the technology and the changes in the market environment, of course, he's bound to fail. Just like we discussed about AI and the IT sector, I think I'm sure if the primary players do not read the tea leaves, probably they would also face challenges.
Vinay, I actually want to take a second just to understand how you think about portfolio construction. Now, when you're managing a mutual fund, a major question that investors always have is a particular fund diversified, under diversified, or over diversified? And I want to understand how you think about that, and where do you draw the line between diversification and over diversification?
I think uh, this is a topic which has seen a lot of debates. Uh, there are some investors who talk about having very few stocks in the portfolio because they can say that having more than five stocks is over diversifying. There are some investors who have 50, 60, 70 stocks in their portfolios, and they think that this is an adequate level of diversification. So uh, I don't think so. There is a mathematical rule which can tell you that this is the perfect level of diversification. The probabilities are tilted in your favor, which is what we as active investors try to do. When you reduce the number of stocks, it becomes like a lottery system. If the market is able to recognize your bets, of course, you have done a great job by identifying superior risk reward trade offs. But if the market recognizes that trade off, wow, that's a lottery ticket for you. But there is a possibility that the market may not recognize, which means that you lose some money or your opportunity cost. But if I spread my bets across, let's say 15, 20, 30, 40 names, then your probability of win, when each of these individual opportunities has a superior probability of win, then the overall result is likely to be much superior with a much superior probability of win. And incidentally, Krish, there is one more aspect which I've recently talked about, and my colleague has actually worked on it, and that is called as the gap between the realized return for an investor versus the realized return of a fund. When you notice this gap, Morningstar does a great job and publishes a classic report called Mind the Gap. And it's a worldwide phenomenon. Investors' returns are generally always lower than fund returns. Why do you think that happens? People generally say that investors are chasing the best funds, etc., etc. Partly that may be true, but the other reason why it can happen is because if you are having a lot of these focused and high volatile funds, the investors automatically keep chasing them. But if the volatility of these funds reduces, automatically the investors' expectation also automatically builds around those kind of returns. And hence, the gap between realized return versus fund return is much, much smaller. So I think uh, there can be lots of debates around this, but my personal view is that having adequate diversification ensures that the probability of win is much higher. Second, the gap between investor return and the fund return also is significantly lower, which is what the expected, which is what is the desired outcome.
In your view, why do you think that all investors should remain bullish on India? Is there specific data points that you can point to that says that despite everything that's happening, things are actually getting better? Or is it a more general macro thing on, all the standard reasons people give?
So I think, see, one is I would not want to talk about what is likely to happen over the next 1 year, 2 years. No point in looking at that because a lot of things can change in 1 year, 2 year period, and you just don't invest for the heck of next 1 to 2 years. What is important is what is likely to happen to a underlying economy over a very long period of time and the nature of companies in that economy. So I think to your question that why would India be an attractive market, not just for Indians, but for global investors. So there are few things which we need to look at. When we look at the global arena of different countries and countries which have different types of arts, which are in different sizes available, uh, India is one of the few large countries which is growing at a pace which is much higher than the global GDP. And this is not for 1 year, 2 year. It is something which is likely to happen over a fairly long period of time. So when IMF or World Bank expect global GDPs to grow at around 3.5%, India's GDP is likely to grow at 6.5, 7% growth rate. not just for 1 year, 2 year, but the next 5 years. Agreed. As your base keeps going up, this growth is likely to slow down, plateau, and keep gradually falling down. But so will be the case for global GDP. The global GDP, which is growing at 3% today, is likely to grow at about 2% in the next 50 years. And India, which is growing at 6 7% today, maybe it will start growing at 3% or 4% after 50 years. Who knows? But that is what the general expectation is all about. So you have a fairly large sized country, and for a foreign investor, a country is like a stock, right? So India is like a large cap stock, which is growing at a fast pace. Second, and I think while this is a very fairly well known fact that India is growing fast, etc., what is not well known is that India has got a largest pool of companies which have got returns on equity in excess of 15%. So if you presume the cost of capital for or cost of equity for various companies in shapes and sizes would be closer to, let's say, 12-13%, you will see a large bouquet of companies which have got sustainable return on equities in excess of 15%. You tell me which are the markets in the world where you are able to identify companies which can grow themselves at nominal 10-11% and generate a sustainable return on equity, an incremental equity, by the way, sustainable return on incremental equity in excess of 15%. And you can count these countries on your fingertips. India is one of them. So that is why if you talk to me about the characteristics of companies which are available in India, fantastic. For any global investor, it is an attractive market. But there is a caveat. The environment today is already capturing in what is likely to happen in the next few years. We have already borrowed some returns from the future. So in terms of returns for the next few years, we expect it to trail the underlying fair value growth. So I think valuations are clearly at a premium. But if you keep that aside, over a longer period of time, clearly this is an area which should attract most of the global investors. And of course, the domestic investors have clearly started taking note of this. So we are already seeing a huge participation from domestic investors, which should keep them in good stead.
I like your point on that there is data to back the idea that India should have some degree of a valuation premium just because there's so many companies that get such fantastic returns on capital. In recent times, is there a particular entrepreneur and or company in India that has particularly caught your eye because you think they've done some fantastic work? What do you think that company or that entrepreneur has got particularly right?
We as external investors are not entrepreneurs. So entrepreneurs take a lot of risks, and they execute on their plan. Sometimes when the risks fructify, we as investors, make judgments, right? That this is not great. They have not made the right capital allocation decisions, so on and so forth. But I think from this perspective, there is one particular entrepreneur which has caught our eye is India's largest food delivery company. So they invested in a quick commerce company when it was about to go bankrupt. And at that point of time, none of us even imagined in our wildest dreams that quick commerce would someday disrupt the modern retail networks. That Indian consumers will take it. The tastes and preferences will change so much. But kudos to them. They took the right kind of risks, and more importantly, executed so well that they are amongst the best in terms of their various types of matrices in terms of execution. So I think if I have good regards for anyone. It is many of these new age entrepreneurs who are taking the right type of risks. Of course, whether or not they succeed, it's also dependent on lots and lots of factors. But the fact is that they are taking a lot of these risks and measured risks. It's not being reckless, but if you are taking measured risks, I think these are people who should be looked upon to. And if you remember, we just talked about the Indian IT sector. We said that they did not take the type of risks, despite the fact that they were making so much of money head over fist. So I think many of these Indian entrepreneurs in the new age businesses are also seeing huge amount of free cash flows, which they are making a lot of money, and they are reinvesting a lot of that money into taking calculated bets in futuristic businesses, in new age businesses, further new ideas, and trying to diversify their businesses. Sometimes some of these things click, they do well. Sometimes they do fail. As investors, we have now started appreciating a lot of these aspects and giving it due for for these kind of risks. So I think that's what we like.
Yeah. And I'm going to end with one simple question. Who is your investing hero?
I started out reading a lot and learning a lot from everyone's guru, which is Warren Buffett. Uh, but over a period of time, it was Philip Fisher who shaped a lot of my thought process, the approach to investing. And then there have been various other investors who have kept on uh, talking about various things, various mental models. Charlie Munger amongst one of them. He's been excellent in his writings, in his speeches. So I think some of these few investors early days have shaped my thought process, and some of them is some of it is like it can never change, and some of it is like it keeps on iterating. You need to keep on iterating and keep on learning. So we are all learning new things, but I think these three investors have made the biggest mark on me.
Thank you so much for taking the time. It was really wonderful having you on the podcast.
Thank you, Krish. It's been a pleasure talking to you.